They did it again. On December 23rd, the CME Group raised silver futures margin requirements by 15%. 7 days later, on December 30th, they raised them again, this time by 30%, and this Monday, January 6th, 2026, they're doing it a third time. In the span of just 14 days, the cost to hold a single silver futures contract will have increased from $16,500 to $32,500. That's a 97% increase. They've essentially doubled the margin requirement in 2 weeks. Now, if you've been following silver, you know margin hikes are the CME's favorite weapon. They deploy them at critical moments when price momentum threatens to break their control. But 3 hikes in 14 days? That's not market management. That's desperation. And here's what nobody's talking about. While they're liquidating leveraged longs on the paper market, the physical market is doing something they can't control. Physical silver premiums are spiking. Delivery delays are stretching to 12 weeks, and in some markets, physical silver is trading at $130 per ounce, while COMEX shows $70. The disconnect is widening. The squeeze they're trying to stop, it's moving to the physical market where margin hikes don't work. This is the story of 3 margin hikes, 97% in 14 days, and why the next 30 days will determine whether COMEX maintains credibility or becomes irrelevant. Let's get into the data. Let me walk you through exactly what happened day by day, because the timing here is not random. December 20th, 2025, silver closes at $74.50 per ounce. Open interest on COMEX is sitting at 173,000 contracts. That's 865 million ounces of paper silver, nearly 10 times the registered physical inventory in COMEX vaults, which at this point is down to 89.7 million ounces. The paper to physical ratio is 9.6 to 1. Meaning for every ounce of physical silver available for delivery, there are 9.6 paper claims on it. That's a problem, and it's about to get worse. December 23rd, 2025, margin hike number 1. The CME issues notice CHAD V25 563. Silver initial margin increases from $16,500 to $18,900 per contract. That's a 15% hike. The official reason? Recent volatility in precious metals markets. But here's the thing. Silver had been consolidating between $72 and $77 for nearly a week. There was no sudden volatility spike. What there was, however, was growing awareness of China's export licensing program set to go live on January 1st. The market was starting to price in supply risk. And the CME's response? Make it more expensive to be long silver. Within 48 hours, silver drops from $74.50 to $71.80. That's a 3.6% pullback. Leverage positions get shaken out. Open interest drops by 8,000 contracts. 40 million ounces of paper silver exits the market. Mission accomplished, right? Wrong. December 28th, 2025, silver bounces back. By the close on Friday, December 27th, it's back at $75.20. The dip got bought hard. And over the weekend, something happens that changes the entire dynamic. On December 30th, China publishes the official list of 44 approved silver exporters. This is the licensing program everyone knew was coming, but now it's real. 121 million ounces of annual refined silver exports, roughly 10% of global supply, are now under Beijing's discretionary control. The market opens Monday, December 30th, and silver gaps up to $77.40. It's running. The margin hike didn't work, and that's when the CME panics. December 30th, 2025. Margin hike number 2. Notice CHAD 25 589. Silver initial margin jumps from $18,900 to $24,570. That's a 30% increase in one move, effective immediately. This is the big one. 30% margin hikes are rare. They're usually reserved for moments when the exchange sees systemic risk, moments when they believe a short squeeze or delivery crisis is imminent. The last time we saw a hike this aggressive was February 2021, when silver briefly touched 30. And just like in 2021, the effect is immediate and brutal. Within 6 hours, silver crashes from $77.40 to $72.10. That's a 6.8% drop. Liquidations cascade. Traders who were holding 10 contracts now have to post an extra $57,000 in margin or get liquidated. Many choose, or are forced, to exit. By the end of the day, open interest has dropped by another 12,000 contracts. 60 million ounces of paper silver wiped out. The CME has successfully triggered a forced selling wave. But here's where it gets interesting. January 1st, 2026. China's export licensing goes live. Midnight Beijing time, the new rules take effect. And within 24 hours, reports start surfacing of delays. Refiners who used to ship silver to Europe and the US within 2 weeks are now quoting 4 to 6 weeks, and that's if the export license gets approved quickly. Physical premiums start ticking up. In Europe, 1,000-ounce bars that were trading at 80 cents over spot are now at $2.40. In India, premiums jump from $1.20 to $3.10. In the US, dealers like APMEX and SD Bullion start showing delayed delivery notices on high-volume products. The physical market is tightening while the paper market is being liquidated, and that sets the stage for what happens next. January 3rd, 2026, margin hike number 3 announced. The CME issues another notice. Effective Monday, January 6th, silver initial margin increases from $24,570 to $32,500. That's another 32% increase. Let's do the math. December 23rd, $16,500. January 6th, $32,500. That's a $15,900 increase, a 97% jump in 14 days. To put that in perspective, if you were holding 10 silver futures contracts on December 23rd, you needed $165,000 in margin. By January 6th, you need $325,000. That's an additional $160,000 you have to come up with in 2 weeks, or your positions get liquidated. Now, the CME will tell you this is prudent risk management, that they're protecting the integrity of the market. But let me show you what's really happening here, because the data tells a very different story. Most people don't understand how futures margin works. So let me break it down in simple terms, because this is critical to understanding what the CME is doing. When you buy a silver futures contract on COMEX, you're not buying 5,000 ounces of physical silver. You're entering a leveraged bet on the price of silver. Each contract represents 5,000 ounces, and at today's price of around $71, that's $355,000 of notional value. But you don't need $355,000 to hold that contract. You only need to post margin, essentially a good faith deposit. Before December 23rd, that margin was $16,500. So with $16,500, you could control $355,000 of silver exposure. That's 21-to-1 leverage. Now here's the key. Margin requirements are set by the CME, and they can change them at any time. When they raise margins, you have to deposit more cash into your account within 24 hours, or your broker will liquidate your position. So let's walk through what happens when the CME raises margins 3 times in 14 days. Trader A holds 10 silver contracts. On December 22nd, he has $165,000 in his margin account. That's comfortable. He's got some cushion. Silver is at $74.50, his position is profitable, and he's planning to hold into February when he believes silver will be at $90 or higher. December 23rd, margin hike number 1. His margin requirement jumps to $189,000. He needs to deposit an additional $24,000. He does it. He's still bullish. December 30th, margin hike number 2. His margin requirement jumps to $245,700. He needs to deposit another $56,700. This is getting expensive, but he's committed. He deposits it. January 3rd, margin hike number 3 announced. Effective Monday, his margin requirement will be $325,000. He needs to find another $79,300 by Monday morning. At this point, Trader A has a decision to make. He's already deposited $80,600 in additional margin over 2 weeks. Does he deposit another $79,300, bringing his total additional margin to $160,000? Or does he cut his position and take the loss? Most traders cut. Because here's the thing. Even if silver goes to 90 in February, the psychological and financial burden of constantly posting more margin wears you down. You start wondering, what if they raise margins again? What if I'm just throwing good money after bad? And that's the trap. The CME knows this. They know that 3 margin hikes in 14 days doesn't just reduce leverage. It breaks psychology. It forces even the most committed bulls to reconsider. Now multiply Trader A by thousands. Because COMEX has 173,000 open contracts, let's say 20% of those are held by leveraged speculators, traders who can't or won't post additional margin 3 times in 2 weeks. That's 34,600 contracts. At 5,000 ounces per contract, that's 173 million ounces of paper silver that's at risk of liquidation. When those positions get liquidated, it creates selling pressure. And because futures markets are leveraged and liquid, that selling pressure shows up as rapid price declines. We saw this on December 30th when silver dropped 6.8% in 6 hours. But here's what the CME didn't anticipate, or maybe they did and they're just hoping it doesn't matter. The physical market doesn't care about margin hikes. If you own 100 ounces of physical silver in a vault, or in your safe, the CME can raise margins to $100,000 per contract, and it doesn't affect you at all. You're not leveraged, you're not getting margin calls, you just hold and wait, and that's exactly what's happening right now. While the paper market is being liquidated, the physical market is tightening, premiums are rising, delivery delays are extending, and in some cases, physical silver is trading at a $60 premium to the COMEX price. Which brings us to the most important question: why is the CME doing this? What are they so afraid of? Let me show you the numbers that are keeping the CME and the banks that control COMEX up at night. COMEX registered silver inventory, 89.7 million ounces. This is the physical silver that's available for delivery against futures contracts. It's sitting in COMEX-approved vaults. It's the backstop of the entire paper market. 89.7 million ounces sounds like a lot until you compare it to open interest. COMEX. Open interest, 173,000 contracts. Each contract represents 5,000 ounces, so total open interest is 865 million ounces. Now, not all of those contracts will stand for delivery. Most futures contracts are closed out before expiration. Traders are speculating on price, not trying to take delivery of physical metal. Historically, only about 2 to 3% of open interest actually results in delivery. But what if that percentage goes up? What if instead of 2% we see 5% or 10%? 5% of 865 million ounces is 43 million ounces. 10% is 86 million ounces. And remember, there are only 89.7 million ounces available. Do you see the problem if even a small percentage of contract holders decide they want physical delivery instead of rolling their contracts or closing them out for cash? COMEX doesn't have enough silver. They'd have to either find more physical silver, which is getting harder because of China's export restrictions, or they'd have to declare force majeure and settle contracts in cash. And if they settle in cash, COMEX loses all credibility as a physical delivery market. It becomes a pure paper casino where prices are determined by leverage and margin rules, not by actual supply and demand for physical metal. That's the nightmare scenario for the CME, and that's why they're raising margins so aggressively. By making it more expensive to hold futures contracts, they're trying to reduce open interest. Fewer contracts means fewer potential delivery requests. It's a preemptive move to avoid a delivery crisis. But here's the catch. The more aggressively they raise margins, the more they reveal their hand. Every margin hike is an admission that they're worried. And smart money sees that. Let me show you what smart money is doing right now. Bank Participation Report, December 2025. The CFTC publishes a report twice a month showing the positions of large banks in the futures market. The latest report, published January 2nd, shows that U.S. banks hold a net short position of 287 million ounces of silver. 287 million ounces. That's 3 times the available registered inventory. Now, banks short silver for a variety of reasons. Some of it is hedging for mining companies. Some of it is market making. But a significant portion of it is naked shorting. Selling contracts without having physical silver to back them up, betting that the price will go down or that they can roll their short positions indefinitely. That strategy works great when prices are falling or stable. But when prices are rising and physical supply is tightening, it becomes a problem. Because if contract holders start demanding delivery, banks have to either find physical silver to deliver or buy back their short positions at higher prices. And right now, finding physical silver is getting harder. China's export licensing went live on January 1st. 121 million ounces of annual exports are now under discretionary control. That's 10% of global refined supply. And early reports suggest that export approvals are being delayed or denied in some cases. Meanwhile, industrial demand for silver is growing. Solar panel production used 130 million ounces in 2025, up from 115 million in 2024. Electric vehicles are using more silver per vehicle, 40 to 50 grams per car, up from 25 grams 5 years ago. 5G infrastructure, medical devices, AI data centers, all of them consume silver, and none of them can substitute it easily. So supply is tightening, demand is growing, and banks are short 287 million ounces. The CME's solution? Raise margins, liquidate leveraged longs, and try to engineer a price decline that gives banks room to cover their shorts. But it's not working the way they planned. Here's the part of the story that's not getting enough attention. While the paper price of silver is being manipulated lower through margin hikes, the physical market is doing the opposite. Let me give you specific examples with real data from the past week. Europe, January 2nd, 2026. 1,000-ounce silver bars traded in London, the global hub for physical silver, are now commanding a premium of $2.40 per ounce over the COMEX spot price. On December 15th, that premium was 80 cents. Why the jump? Dealers are reporting that refineries in Switzerland, which process a significant portion of global silver, are quoting delivery times of 6 to 8 weeks for new orders. Normally it's 2 to 3 weeks. The delay is partly due to China's export restrictions. Swiss refineries import silver concentrate from China, refine it into bars, and export it globally. But with export licenses now required, shipments are being held up. Refineries are running low on feedstock, and they're prioritizing existing orders over new ones. Result: European silver buyers are paying $2.40 over spot because spot silver, the paper price on COMEX, doesn't reflect the actual cost of getting physical metal delivered. India, January 3rd, 2026. India is the second largest consumer of silver in the world, behind China. Indian buyers use silver for jewelry, religious purposes, and increasingly for solar panels and electronics manufacturing. Premiums in India have jumped to $3.10 per ounce over COMEX spot, up from $1.20 on December 20th. Import duties and logistics explain part of that premium, but the sudden spike is due to supply concerns. Indian importers are worried that if China tightens exports further, they'll struggle to source silver at any price, so they're buying now at elevated premiums to lock in supply, and that demand is pulling physical silver out of global markets. United States, January 3rd, 2026. Let's look at U.S. retail dealers, the places where individual investors buy silver. APMEX, one of the largest online dealers, is showing delayed delivery on American Silver Eagles and 10-ounce bars. Normally, these products ship within 3 to 5 business days. Right now, the estimate is 3 to 4 weeks for new orders. SD Bullion has raised premiums on 100-ounce bars to $4.50 over spot, up from $2 in mid-December. Their website shows limited inventory on several high-volume products. JM Bullion is quoting 6 to 8 weeks for large orders, anything over 10,000 ounces, and they're requiring higher deposits up front, citing supply chain uncertainty. Now you might think, okay, dealers are running tight on inventory. That happens sometimes. They'll restock in a few weeks. But here's the problem. Where are they going to restock from? Refineries are backed up. China's exports are restricted. COMEX registered inventory is at an 8-year low. And industrial users, solar manufacturers, electronics companies, automakers aren't cutting back on silver purchases. If anything, they're increasing orders to build buffer inventory in case supply gets tighter. So the physical market is experiencing what I'd call a slow-motion squeeze. It's not a sudden panic where everyone rushes to buy silver in one day. It's a gradual tightening where premiums creep higher, delivery times stretch longer, and dealers quietly start turning away large orders because they don't have the metal and they're not confident they can source it. And the most insane part, while all of this is happening, the COMEX price is being pushed down by margin hikes. On December 30th, COMEX silver closed at $72.10, down 6.8% from the morning high. But if you tried to buy 1,000 ounces of physical silver that day, you'd pay $74.50 in Europe, $75.20 in India, or $76.60 in the US after premiums and logistics. The paper price says 72, the physical price says 75 to 77. That's a $3 to $5 disconnect. And in some isolated cases, reports are hard to verify, but they're circulating. Physical silver has traded as high as $130 in Asia for immediate delivery of large quantities. $130. COMEX shows 72. That's a $58 difference. Now, I'm not saying 130 is the real price of silver. That's an outlier, likely a distressed buyer who needed metal immediately for an industrial contract and had no other option. But the fact that any transaction happened at that price tells you something is breaking. The paper market and the physical market are decoupling, and when that happens, one of two things occurs. Either the paper market reasserts control, COMEX prices rise to reflect physical reality, traders arbitrage the gap, and equilibrium is restored, or the paper market loses credibility. Traders stop trusting COMEX as a price discovery mechanism, and physical transactions move to different venues where prices are set by actual supply and demand, not by margin hikes and bank shorts. We're at the early stages of this decoupling. The next 30 days will determine which way it goes. If you're thinking, okay, this sounds dramatic, but hasn't the CME done this before? Don't they always raise margins when silver rallies, and doesn't the price always come back down? That's a fair question. Let me walk you through the historical precedent because there are similarities to past episodes, but there are also critical differences that make this time potentially more dangerous. May 2011, the original silver margin massacre. Silver peaked at $49 on April 25, 2011. In the span of 9 days, the CME raised silver margins 5 times, from $11,000 per contract to $21,000. That's a 91% increase in 9 days. The result? Silver crashed from $49 to $32 in a week. Leveraged longs got obliterated, open interest collapsed. And silver spent the next 4 years grinding lower, eventually bottoming at $14 in December 2015. The CME successfully killed the rally. And for years, that playbook worked. Every time silver tried to break out, the CME would raise margins and the rally would die. But 2011 had a key difference. There was no physical supply crisis. In 2011, China was exporting silver freely. Refineries had excess capacity. COMEX registered inventory was over 140 million ounces, 50 million more than today. And industrial demand for silver was lower because solar and EV markets were much smaller, so when the CME crushed the paper market, there was no physical market rebellion. The two markets stayed coupled. Paper went down, physical followed. February 2021, the Wall Street Bets squeeze attempt. Fast forward to February 2021. Reddit's Wall Street Bets community tried to squeeze silver the same way they squeezed GameStop. The hashtag $silversqueeze went viral. Silver jumped from $25 to $30 in 3 days. The CME responded immediately. They raised margins from $14,000 to $16,500, an 18% hike. Silver pulled back to $26. The squeeze failed. But again, there was no supply crisis. Physical premiums ticked up for a few weeks. Silver Eagles were selling at $8 premiums, but supply was never seriously threatened. Dealers restocked within a month. Industrial users didn't panic. The system absorbed the surge in retail demand without breaking. 2026. Why this time is different. Now let's look at today. The CME has raised margins 97% in 14 days. That's even more aggressive than 2011. But the supply backdrop is completely different. China has restricted exports. 121 million ounces per year are now under licensing control. Refineries are backed up. COMEX inventory is at an 8-year low. Industrial demand is at an all-time high. And there's growing geopolitical tension around critical minerals, which silver is increasingly classified as due to its use in defense electronics and green energy. So when the CME crushes the paper market, the physical market isn't following this time. Premiums are rising, delivery delays are extending, and buyers who need physical silver for industrial use are starting to bypass COMEX entirely, sourcing metal directly from producers or paying premiums for immediate delivery. This is the key difference. In 2011 and 2021, the CME could control both the paper and physical markets because physical supply was abundant. In 2026, physical supply is constrained, so margin hikes work to liquidate paper longs, but they don't solve the underlying supply problem. And if the supply problem gets worse, if China tightens exports further, if industrial demand continues to grow, if COMEX inventory drops below 80 million ounces, the paper market becomes irrelevant. Physical buyers will just pay whatever price is necessary to secure metal, and COMEX will be left as a sideshow where banks trade paper contracts that nobody trusts. That's the endgame the CME is trying to avoid, and that's why they're raising margins so aggressively. They're trying to buy time. Time to bring more physical supply online, time for demand to soften, time for the narrative to shift, but time is running out. Let's talk probabilities. Based on the data we have right now, I see 3 possible scenarios for how this plays out over the next 30 to 60 days. Scenario 1, the managed retreat, 40% probability. In this scenario, the CME's strategy works, partially. The 3 margin hikes succeed in reducing open interest to a manageable level. Silver consolidates between $68 and $75. Physical premiums stabilize at $2 to $4 over spot. Delivery delays gradually improve as refineries work through backlogs. China approves enough export licenses to keep supply flowing. By March, the panic subsides. Industrial buyers have secured enough inventory. Retail demand cools off as prices stall. And silver enters a multi-month consolidation phase where it trades sideways, with occasional spikes quickly beaten back by additional margin hikes or intervention. This is the soft landing scenario. The system bends but doesn't break. COMEX maintains credibility. Banks slowly cover their short positions, and the market moves on to the next crisis. I give this a 40% probability. It's possible, but it requires a lot of things to go right. China has to cooperate, industrial demand has to soften, and no major bank can blow up from a bad short position. Scenario 2, the full squeeze, 35% probability. In this scenario, the physical supply crisis accelerates, China further restricts exports, refineries fall further behind, industrial buyers start panic bidding for silver because they can't afford production shutdowns. Physical premiums explode, 5, $10, $15 over COMEX spot. At some point, the arbitrage becomes too obvious to ignore. Traders start buying COMEX futures, standing for delivery, and immediately reselling the physical silver at a premium. That arbitrage closes the gap, but it forces COMEX prices higher to match physical reality. Silver breaks $90 in February, $100 in March. Open interest collapses as speculators exit, and the market becomes dominated by industrial hedgers and physical buyers. The CME raises margins again, maybe to $40,000 or $50,000 per contract. But it doesn't matter because the move is driven by physical supply, not leverage. Banks short silver face catastrophic losses. Some may require bailouts or forced liquidations of other assets to cover. The financial media starts calling it the silver crisis of 2026. I give this a 35% probability. It's a plausible outcome, especially if China decides to weaponize silver exports or if a major industrial user publicly announces they can't source metal. Scenario 3, the COMEX disconnect, 25% probability. This is the most extreme scenario, but also the most fascinating from a market structure perspective. In this scenario, COMEX loses credibility entirely. Physical silver continues to trade at massive premiums to COMEX, $20, $30, $50 higher. But instead of COMEX prices rising to close the gap, traders just stop using COMEX as a reference price. Industrial buyers negotiate contracts based on physical delivered prices, not COMEX spot. Dealers quote premiums so large that they're effectively setting their own prices independent of COMEX. And over-the-counter markets, private transactions between producers, refiners, and large buyers become the primary venue for silver trading. COMEX becomes a legacy market, still functioning but increasingly irrelevant. It's like an old stock exchange that's technically still open but nobody uses because there are better alternatives. I give this a 25% probability. It would require a severe loss of confidence in COMEX, maybe a publicized delivery failure, or a major bank defaulting on silver contracts. It's the tail risk scenario, but it's not impossible. So 40% managed retreat, 35% full squeeze, 25% COMEX disconnect. In aggregate, there's a 60% chance of significant disruption, either a squeeze or a disconnect. Those are not comfortable odds if you're the CME or a bank short 287 million ounces. Let me tell you what I'm doing with my own money because I get asked this constantly and I want to be transparent. I'm long physical silver. I've been accumulating since silver was in the 50s, and I've added to my position on every major dip, 68, 71, and I'll add more if we see 65. My allocation to silver is about 22% of my investable assets. That's higher than most advisors would recommend, but I'm comfortable with the risk reward at these levels. I'm not touching futures. I don't want to deal with margin calls, and I don't want to play the game the CME is rigging. If you're trading futures, you're playing on their turf with their rules, and they can change the rules whenever they want. I'm opting out of that game. I'm also holding positions in 3 silver mining stocks: First Majestic, Hecla Mining, and Pan American Silver. These are leveraged plays on silver price, but they come with operational and geopolitical risks. I'm keeping these positions smaller, about 8% of my portfolio combined. And I'm holding some cash, about 15%, specifically to buy more physical silver if we get another panic dump. If silver touches 65 because of a margin hike or a liquidation event, I'll be a buyer. Because at this point, every forced dip just makes the eventual squeeze more violent when it arrives. Now, I need to be very clear, I am not a financial advisor. This is not financial advice. I'm sharing what I'm doing, but you need to make your own decisions based on your own risk tolerance and financial situation. But here's my thesis in simple terms. The physical supply of silver is getting tighter. Industrial demand is growing. China is restricting exports. And COMEX is underwater on paper shorts. The paper market can suppress prices temporarily through margin hikes, but it can't create physical metal. At some point, physical reality wins. I don't know if that point is next week, next month, or next year, but I'd rather be 6 months early than 1 day late. Because when the squeeze happens, if it happens, it's going to be fast, and you won't have time to position. So I'm positioned now, and I'm waiting. If you're following this story, here are the specific data points and events you should be tracking over the next 30 days. 1. COMEX registered inventory current level, 89.7 million ounces. If this drops below 80 million ounces, that's a red flag. Below 70 million ounces, that's a crisis. You can check this weekly at the CME Group website. They publish a report every Friday showing registered and eligible silver in COMEX vaults. 2. Physical premiums track premiums in Europe, India, and the US. If they widen beyond $5 over COMEX spot, that's a sign the disconnect is accelerating. You can monitor this through dealer websites like APMEX, SD Bullion, and European bullion exchanges. 3. Shanghai silver premium. The Shanghai Gold Exchange lists silver prices in yuan. If the premium of Shanghai silver over COMEX exceeds $10, that indicates serious supply stress in Asia and potential arbitrage opportunities. There are several websites that track the Shanghai COMEX spread in real time. 4. Open interest current level, 173,000 contracts. If this drops below 150,000, it means the margin hikes are successfully reducing leverage. If it stays above 165,000 despite 3 margin hikes, it means there are committed buyers who aren't being shaken out. That's bullish. 5. Silver ETF flows. Watch the iShares Silver Trust, ticker SLV, and Sprott Physical Silver Trust, ticker PSLV. If you see consistent inflows, meaning more silver is being added to the trusts, that's a sign institutional and retail buyers are still accumulating despite the volatility. SLV currently holds 484 million ounces. Any drawdown below 450 million is significant. 6. Refinery delivery times. This is harder to track publicly, but if you have contacts in the industry or you follow dealer announcements, pay attention to delivery time estimates. If refineries go from quoting 6 weeks to 10 or 12 weeks, that's a sign the supply chain is breaking. And if refineries start turning away new orders entirely, that's the endgame. 7. CME margin announcements. Obviously. If the CME raises margins a 4th time, that's an admission that the first 3 hikes didn't work. And at that point, you have to ask, what's the limit? Can they raise margins to $50,000, $100,000? At some point, they price out all but the largest institutional players, and the market becomes so thin that it's useless for price discovery. 8. Bank earnings and disclosures. In late January, major banks will report Q4 earnings. Pay attention to any mentions of commodities trading losses or restructuring in their metals desks. If a bank like Goldman Sachs or Morgan Stanley discloses losses on precious metals, that's a sign the short positions are bleeding. 9. China policy announcements. Beijing could tighten exports further, or they could ease restrictions if it serves their strategic interests. Any announcement from China's Ministry of Commerce regarding the silver export licensing program should be treated as market-moving news. 10. Silver options expiry, February 14th. There are currently 47,000 open call options at the $80 strike, expiring February 14th. If silver is above 80 on that date, those options go in the money and can be exercised for physical delivery. That's 235 million ounces of potential delivery demand, more than twice the registered inventory. February 14th is a key date. Mark your calendar. These 10 data points will give you a real-time picture of whether the squeeze is building, stalling, or reversing. Let me zoom out for a minute because this story is about more than just silver. It's about the credibility of paper markets in a world where physical supply is increasingly weaponized. For decades, COMEX, the London Metals Exchange, and other commodity futures markets have functioned as the primary mechanism for price discovery. Producers, consumers, and speculators all agreed to use these venues because they were liquid, transparent, and, crucially, they allowed for physical delivery if you wanted it. But what happens when one of the largest suppliers, in this case China, decides to restrict exports and use supply as a geopolitical lever? What happens when the physical market stops trusting the paper price? We're seeing this play out in real time, and silver is just the beginning. China has already signaled they're considering similar export restrictions on other critical materials: gallium, germanium, tungsten, rare earths. These are the raw materials for semiconductors, defense systems, renewable energy, and advanced manufacturing. If buyers of these materials lose confidence in futures markets and start hoarding physical supply, the entire commodity trading system fractures. And central banks and governments, who rely on these markets for price stability and inflation data, lose a critical tool for managing the economy. That's the bigger picture. Silver is the canary in the coal mine. If COMEX loses credibility on silver, other commodity markets are at risk. And if physical supply becomes the dominant driver of prices instead of paper leverage, we're entering a new era, one where access to resources matters more than financial engineering. This is why the CME is so desperate. They're not just defending the silver market. They're defending the entire paper commodity system. So let me bring this all together because I want to make sure the thesis is crystal clear. The CME raised silver margins 3 times in 14 days, a 97% increase, in an attempt to liquidate leveraged longs and suppress the price. On the surface, it worked. Silver dropped from $77.40 to $71.10. Open interest declined. The rally was halted. But beneath the surface, the physical market didn't follow. Premiums rose, delivery delays extended, and buyers who actually need physical silver started bypassing COMEX entirely. The trap the CME set, raising margins to force selling, has now become a trap for the banks. because every margin hike reinforces the narrative that COMEX is a rigged paper market disconnected from physical reality. And the more that narrative spreads, the more buyers move to physical, which tightens supply further, which makes the eventual squeeze more violent. The CME thought they were preventing a crisis. Instead, they may have accelerated it. And that's the irony. The very tool they're using to maintain control, margin hikes, is the tool that's undermining confidence in the market they're trying to protect. So here's my prediction. Over the next 30 days, one of two things happens. Either the physical supply situation improves, China eases exports, refineries catch up, industrial demand softens, and silver consolidates in the low 70s, giving banks time to cover their shorts and the system time to heal. Or the physical supply situation deteriorates. More export restrictions, more delivery delays, more panic buying, and silver breaks $90 despite margin hikes, forcing COMEX to either allow massive delivery or admit they can't fulfill contracts. 60% chance of the second outcome, in my view. And if I'm right, the next few weeks are going to be very, very interesting. Tomorrow, I'm publishing a deep dive on the 44 approved Chinese silver exporters, who they are, how much they control, and what their approval status means for global supply. If you want to understand exactly how much leverage Beijing has over the silver market, you won't want to miss that video. I'm also tracking COMEX inventory daily and posting updates on the community tab. If we see a sudden drop below 85 million ounces, I'll be covering it immediately. If you found this breakdown valuable, hit the like button. It helps more people find this content. Subscribe and turn on notifications so you catch tomorrow's video. And drop a comment below. I want to know, do you think silver hits $100 before March? Or does the CME successfully suppress it? Let me know. I'll see you tomorrow.